Which stock made the biggest return since 1995? Apple, Amazon, Nvidia? Wrong. Monster Beverage beats all of them, the stock you never even thought of. That's the availability bias. Now jump to 2021. Bitcoin hits an all-time high. Everyone online is making money. And you're missing out. Thinking, why am I the only one not getting rich? So you buy. 6 months later, you're down 50%. This isn't stupidity, it's psychology. Today, we're breaking down the hidden mental traps that make you lose money. And yes, we'll also see what $1,000 in Monster stock would be worth today. The example of Bitcoin was of course the fear of missing out, to which we are very susceptible as humans. Be it Tesla, Nvidia or gold recently. FOMO can fuel bubble formation and, for small investors, mostly leads to bad market timing. But if you sold your Bitcoin investment in 22, following the crash, seen from now this would have been a bad idea, as it shot back up in 24. But you can't know, can you? All you see is this. And you don't know if it's going to drop another 50%, rise again or go sideways.
Nobody knows if the stock is going to go up, down, sideways, or in fucking circles.
This is the hindsight bias. Most people and investors overestimate how predictable events had been previously. Like investing into Amazon would have been a great idea in the 90s. Yet in the dot-com bubble in the 2000s, many internet startups failed and aren't remembered now. But could you have known that Amazon was one of the few that survived? Whilst also dropping 95% in the crash, by the way. This is the survivorship bias, because now you only see those that have succeeded. Of course, the best option would have been to invest in Monster, but more on that later. First, imagine I offer you a game and you have to pick one option. Option A, I present you a Wheel of Fortune and there is a 60% chance to gain $1,500, but a 40% chance you lose $1,000 and have to pay me. Option B is a guaranteed gain of $200, so what would you choose? Most people pick option B, the guaranteed gain of $200. But is this rational? You see, option A has a much higher expected value of $500 compared to the safe $200 from B. Even professional investors prefer B because the 40% chance of losing $1,000 feels heavier than the potential upside. This is loss aversion. We feel losses almost twice as strongly as equivalent gains. This bias is what the whole insurance industry is based on. Now imagine there had been 9 other people before you that all took the bet and spinned the wheel, which economically is the better decision, yet they all were unlucky and lost. Would you try it now? Okay, maybe you think it's a scam, but I guarantee you the game is fair. So what are the odds that it lands on the losing side 10 times in a row? Well, exactly 0.4 to the power of 10, so about 0.01%. So now of course you would take the bet, right? That's the gambler's fallacy, because if you spin the wheel now, the chances are still 60 to 40%. Nothing changed, because the previous outcomes have no influence over the next. If we had bet on it landing on the losing side 10 times, that would have been a 0.01% chance. But we're only betting on one round. In investing, this translates to the idea that this stock dropped 9 days in a row. It must go up now. The overconfidence bias is simple yet potent. Almost everyone overestimates themselves. In a survey, professional fund managers were asked if they were above average at their job. 74% said yes. Mathematically impossible. And this isn't just a problem for the pros. We've all met that friend, or maybe we've been that friend, who says, I invest 80% in the S&P 500 and 20% in undervalued companies to boost my returns. Sounds smart. But wait, buying undervalued stocks isn't a strategy. It's the entire game. Everyone wants to buy undervalued stocks. The challenge is knowing which ones are actually undervalued. That's exactly where private investors like you and me tend to overestimate their ability. But this goes for professionals as well, because on average, actively managed funds do not beat the market. The next effect is anchoring. Would you say that if this watch was on sale from $100 to $50, this would be a good deal? Well, it originally only cost $20 on Amazon, yet the first price of $100 acted as an anchor for the judgment. This is the same with buying stocks. The purchase price often acts as an anchor. If we buy a stock at $100 and it falls, we automatically think it should at least go back to that 100. Even though, as in our example, the true value might have been even lower, and we would still benefit from selling now before it falls further. The confirmation bias is one of the most dangerous traps in investing, because it feels like research. Say you're thinking about buying Tesla. You type, "Is Tesla a good investment?" into Google, and surprise, you get thousands of bullish articles and optimistic YouTube thumbnails. But the other side is also important. Why might Tesla be overvalued? Investors naturally seek information that confirms their existing beliefs. And it gets worse. Once we own a stock, this effect doubles. Because with a monetary stake in the company comes a psychological one. And this can really influence the next bias. Imagine you have two stocks in your portfolio. Stock A is up 20% and stock B is down 20%. Which one should you sell? Most people, including me, would instinctively sell stock A, because, well, then we made a profit. The disposition effect explains something almost every investor has done: selling winners too early and holding losers too long. Because rationally, without any further information, we have no reason to sell or hold either. We should evaluate both based on future prospects. We can't know if stock A will be up 200% next month, or stock B down by 80%, in which cases selling B would have been the better option. The home bias leads us to overinvest into familiar companies or a home country. Americans typically almost exclusively invest into American stocks. European investors usually overweight European or their home country stocks in their portfolios. Of course, for the Americans this has worked out quite well in recent years, yet it still reduces diversification. Before we dive into the final bias, arguably the most human one of all, let's return to our Monster Beverage story. What would an investment look like today? Well, if you had invested $1,000 in August of 1995 in Monster Beverage stock, which at the time was a mere penny stock, it would be worth about $7,371,500 today. First, it was a small juice company selling soda and natural juices. It pivoted to energy drinks in 2002, creating an entirely new, high-margin category, and made millions. Well, that's one success story, but stories can also deceive investors. Humans love stories. They help us make sense of a chaotic world. But in markets, stories can be dangerous. This is the narrative fallacy, the tendency to create simple explanations for complex events. Investors fall for this all the time. AI will change everything, or this CEO is a genius, which is a classic story. I mean, look at Steve Jobs with Apple, or Elon Musk with Tesla. Now there's one more thought I want to leave you with before we wrap it up. If millions of investors share the same psychological quirks, those quirks don't just affect individuals, they shape the market itself. Bitcoin, gold, Tesla, Apple, none of them have an inherent value independent of what people believe they're worth. Narratives, confidence, fear, they all feed back into prices. So yes, anchoring, narratives, like the myth of the genius CEO. When enough people buy into them, they temporarily become part of the market's reality. It doesn't make the biases rational, but it explains why markets sometimes behave like they have a memory or a personality of their own. In the end, investing isn't just about numbers, charts or balance sheets. It's about us. our fears, our impulses, our strategies, our stories. Markets don't move rationally because people don't think rationally. But once you understand these psychological traps, from FOMO to loss aversion, from confirmation bias to the narrative fallacy, you gain something far more valuable than a stock tip. You gain awareness. And awareness is what turns chaos into strategy. You can't eliminate emotions from investing, but you can start to notice them, question them, and even use them. Because in the long run, mastering the mind is just as important as mastering the market.